Welcome to the Deep Dive, your shortcut to understanding complex topics. Today, we're taking a deep dive into the second quarter 2025 results from INWIT. That's the big Italian tower company.
Right, and it's a fascinating look, really, at how a crucial piece of Italy's digital backbone is performing.
Absolutely. This deep dive, well, it offers a truly illuminating perspective on the evolving European tower infrastructure landscape, wouldn't you say?
Definitely, especially, with Italy's ongoing 5G rollout challenges and the unique economic pressures facing mobile network operators across the continent.
It's not just about the numbers then.
No, it's about strategic positioning in what's really a high-stakes environment.
Exactly.
Yeah.
So our mission today is to unpack not just how INWIT navigated the quarter, but their strategic positioning for the future, and most importantly, what these results and their strategy could mean for you as we head into the second half of the year.
Let's dig in.
Okay, so starting with the immediate takeaways, what were the headline numbers from INWIT Q2 earnings call?
Well, the top-line story was pretty strong. INWIT, he reported revenue of $269 million for Q2, which represents a solid 4.6% increase year over year. And that figure actually came in slightly ahead of what consensus estimates were predicting.
Always a good sign.
Yeah, exactly. In this sector, definitely.
That's a good start. But how did that translate down to the bottom line? Was there any sort of disconnect there?
It was a slight nuance, yeah. While revenue showed clear strength, GAAP net income, that came in at $93.4 million. Now, that was a slight miss compared to street expectations, but it's really important to look beyond just that net income line.
Right, the underlying metrics.
Exactly. The underlying profitability metrics were incredibly robust. I mean, we saw EBITDA hitting $246 million.
Wow.
Which translates to an eye-popping 91.4% margin. And then there's EBITDA after lease EBITDAaL, which reached $196.4 million.
Okay.
And that pushed their EBITDAaL margin up to 73.0%. That's a very healthy 60 basis point expansion year over year.
That expansion is, well, it's pretty key, isn't it? It shows efficiency.
It really is. It's a key indicator of their operational efficiency and their ability to manage costs, especially those lease obligations.
So robust margins, despite maybe a slight net income miss. And what about the cash flow side and their operational achievements for the quarter?
Yeah, cash front was quite strong. Recurring free cash flow was $157.9 million.
And that's the key metric for infra, right?
Absolutely. It's the cash they generate consistently from operations after basic CapEx, vital for an infrastructure company like this.
And operationally, towers, POPs.
Yeah, they kept expanding their footprint, added 210 new towers. But what's maybe even more telling is the addition of 720 new points of presence, or POPs.
POPs. Remind us quickly.
Think of them as the crucial connection points, the physical locations where mobile operators connect their gear to INWT's towers.
Got it.
And adding those POPs boosted their overall tenancy ratio to an impressive 2.36 times.
2.36. That's strong. How did the market react to all this? Did investors kind of see the same underlying strength we're talking about?
The market's immediate reaction was certainly positive, yeah. Share price climbed 1.2% by the close of the session after the announcement.
Okay.
And it was trading on significantly higher than average volume. So this isn't just a small bump.
Right. The volume tells a story.
Exactly. That higher volume indicates broad investor alignment with management's confidence, with the company's strategic direction. It suggests the market, understood the nuance, the net income miss versus the really robust operational profitability.
But to unpack this a bit further then, beyond just the raw numbers, what was the overarching message, the theme from management during the call? What do they really want to hammer home?
What resonated most strongly, I think, was management's consistent emphasis on the resilience, the inherent resilience of their shared tower model.
Right.
They framed it not just as a stable business, but as a critical enabler, one with significant capacity to, fund Italy's ongoing 5G rollout.
That's a very confident stance on their core business.
Very confident.
And how was that confidence conveyed? Did they reaffirm their long-term vision?
Oh, absolutely. That sentiment resilience capability was powerfully echoed by the GM Diego Galli. And crucially, they didn't just talk the talk. They reaffirmed their full year 2025 outlook across the board.
Across the board. So revenue, EBITDA.
Everything. Revenue projections still between 1.07 and 1.09 billion. EBITDA margins still greater than 91%. EBITDAaL margins still above 73%.
Wow.
On the cash side, recurring free cash flow is still expected between 630 and 640 million. And significantly, they committed again to that 7.5% increase in dividend per share.
That kind of reaffirmation, positive signal, it really speaks volumes, doesn't it?
It really does. Shows internal confidence.
Okay, so strong reaffirmation, positive signal. Operationally, what trends really stood out? You mentioned new towers, POPs. Was there anything particularly interesting about where they're focusing their growth?
Yeah, what truly caught my eye was the significant growth in their smart infrastructure and distributed antenna system, or DAS sales.
Okay.
These surged by an incredible 40% year on year, reaching over 22 million.
40%. That's huge.
It is. And this isn't just about adding more traditional towers, right?
Yeah.
This highlights INWIT's very specific, differentiated focus on high-density urban and indoor connectivity.
So inside buildings, stadiums, that sort of thing.
Exactly. DAS are those small, localized antenna systems that boost signal where big macro towers struggle, large buildings, stadiums, busy city centers. It's a premium, high-value segment.
That focus on urban density and specialized stuff like DAS seems like a smart play.
Yeah.
What other strategic moves are helping their efficiency, helping those margins?
Well, what's truly fascinating here, and it directly feeds into those expanding EBITDAaL margins, is their strategic land purchase program.
Ah, the land buying. Right.
They've been actively buying the land their towers sit on rather than just leasing it long term.
Makes sense.
They've now bought out 16% of their land, and they have an ambitious target, 30% by 2030.
So that directly cuts costs.
Directly contributes to real estate efficiencies, yeah. Reduces long-term lease costs, frees up capital, and, as we mentioned, that tenancy ratio, 2.36 times. It's not just a number.
You know, it positions them high up in Europe.
Exactly. Among the highest. It means they're getting maximum usage from each tower. Huge competitive advantage, cost efficiency, profitability per site.
Sounds like they're really sweating those assets effectively.
Yeah.
Now, beyond the financials, the operational stuff, what about their broader impact? ESG, environmental, social governance. Was that a big part of the call?
Absolutely, yeah. Increasingly important for investors, and INWT highlighted significant progress. They reported that a remarkable 80% of their electricity now comes from renewables.
80%, that's substantial.
It's huge for a company with that kind of physical footprint, a big step towards sustainability. But it's not just environmental.
It's social, too.
Yeah, they also expanded nearly 800 new POPs in what they called vulnerable areas. So that directly underscores their commitment to reducing the digital divide in Italy.
So it's good business and good citizenship, basically.
That's the idea. Builds goodwill, ensures the network serves a broader purpose.
Okay, connecting all these pieces.
Yeah.
The bigger picture, especially the Italian telecom market, how does INWIT position itself relative to its clients, the mobile operators, who everyone knows are under pressure?
That's a really important point. Management was open about it. They addressed Italy's lagging digitalization, the urgent need for faster 5G investment, especially with mobile data traffic growing double digits.
Right.
And while they acknowledged, direct quote here, that their telco clients are indeed under pressure, limiting discretionary investments.
They don't see that as a problem for them.
Exactly. Instead, they position themselves as a critical enabler of efficiency for those customers.
How so?
By providing the shared infrastructure, INWIT lets telcos expand their 5G reach more cost-effectively, without the massive capital hit of building all their own sites.
So it's symbiotic, even when one side's feeling the pinch.
Precisely. They're offering a solution to a problem their clients have. Powerful position.
Okay, so they're the solution. What does this all mean for INBP's capital allocation? Shareholder returns.
Well, it clearly means enhanced shareholder returns are a priority. They've already executed 107 million of their authorized 400 million share buyback program.
That's pretty aggressive.
It is. Signals strong management confidence in the stock's value. On top of that, they're offering a substantial dividend yield, around 7%.
Makes them attractive for income investors.
Very attractive. And their leverage, 3.5 times net debt to EBITDA, it reflects these returns but stays consistent with their optimization path. It's a balance.
Returning capital but keeping flexibility.
Yeah.
Makes sense. And looking beyond current operations, stated goals. Where do they see future growth? Just more towers, or are they looking at, new frontiers?
This is where it gets really interesting for their long-term story. They are actively scouting opportunities in areas like RAN as a service.
RAN as a service.
Right.
Radio access network.
Exactly. So not just leasing tower space, but maybe offering the actual radio gear and infrastructure for telcos to use, a more comprehensive managed service.
Okay, and the other area?
Edge data centers, addressing that critical need for computing power closer to the user right at the edge of the network.
Bringing processing closer to the data source, reducing latency.
You got it. Enabling new applications. And they see these ventures as very similar to their core tower model.
How so?
Promising long-term visible returns and a wholesale approach, serving multiple clients. They're not just dabbling. They project a robust 6% annual EBITDA growth out to 2030.
6% annual growth at 2030.
Yeah, with plenty of financial headroom, they say, for more strategic investments in these areas. It's a clear roadmap to evolve beyond just traditional towers.
That is a significant projection, a compelling vision. Turning to the investor context, you mentioned the modest share price pop, higher volume. What does that tell us about how the market's really digesting these results, this outlook?
Yeah, the modest pop, the high volume. It really does suggest investor alignment with management's confident, quite bullish tone. It's not speculative froth. It's a measured, positive response.
And the analysts, what are they saying?
Sell-side analysts are largely on board. Berenberg, for instance, they lauded the solid beat on cash metrics. They affirmed their investment thesis remains unchanged, seeing INWIT as a stable infrastructure yield play.
A reliable income generator.
Primarily, yes. That's the current perception.
But despite that positive vibe, analyst support, how has INWIT actually performed against the broader market, say the FTSE Best Index in Italy? Is there a gap? Upside potential?
That's a crucial point, actually. While INWIT has seen a strong rebound, it's up 19% from its 52-week low, which is great.
Yeah.
It's worth noting it has trailed the broader FTSE Best Index over the past month, the past quarter, even the full year.
So it's lagged the index.
It has, and that performance gap is significant. It hints that, there's still potential for further upside, for a re-rating maybe, if certain key catalysts materialize and close that perceived value gap.
Okay, so what are those catalysts? What should we be watching for that could potentially unlock this upside and close that gap?
There are a few immediate ones coming up. First, keep a close eye on the Q3 earnings print and any guidance update. That's expected early November. Strong results there could really build momentum.
Right, Q3 print. What else?
Second, the completion of their phase 1 share buyback by December. That signals continued commitment to shareholder returns, takes shares off the market. And finally, any potential M&A ripple effects. Big European telco or tower deals could cast a favorable light on INWIT, maybe highlighting the value of similar assets.
Okay. So if these catalysts hit, how does that fundamentally change the story around INWIT? What's the transformation we might see?
Well, this really positions INWIT to potentially evolve from what some might see now as maybe a defensive bond proxy.
Like a stable, maybe slightly boring bond alternative.
Kind of, yeah. Stable returns, dividends. Evolve from that to a true controlled growth compounder.
A compounder, meaning?
A company that consistently grows its earnings, its returns over time, often reinvesting smartly for future growth. So strong execution on these catalysts, Q3, buyback, M&A environment, could unlock a significant re-rating.
Pushing the stock towards that 11.20 52-week high. Or maybe beyond.
Potentially, yeah. It's about shifting that perception from stable utility to dynamic, controlled growth.
All right. This is the part of the deep dive where we put on our speculative hats.
My favorite part.
Standard disclaimer. This is absolutely not financial advice, purely for entertainment, thought provocation. Given everything we've heard, I've got a couple of, let's call them outrageous but plausible trade ideas for you to mull over.
Okay, always a good time. Lay them on us. Ready to be provoked.
Okay, idea number 1. A tactical short position on some of the legacy European fixed-line telco operators.
Ooh, short the telcos. Bold. Rationale.
The rationale comes straight from INWIT's management. They explicitly said telco clients are limiting discretionary investments due to cash flow pressure. They even said the Italian telecom sector is not sustainable currently.
The strong words.
Very strong from a key partner. It suggests a deeply challenging environment for those underlying telcos. Could mean continued pressure on their financials, maybe further declines. So the idea is capital flows shift.
Exactly. As capital maybe shifts from struggling legacy players into essential resilient infrastructure like INWIT, those telcos could be ripe for a short play. It's betting on the distress of the old guard, basically.
Contrasting with the growth of the new infrastructure. Okay, certainly highlights the two sides of that digitalization coin. What's your second idea then?
Idea number 2. Let's go long INWIT call options.
Long calls on INWIT itself. Which ones?
Specifically, maybe buying at the money or slightly out of the money calls, expiring, say, late 2025 or early 2026. Give it some time.
Okay, the argument for that.
The argument here feels compelling. You've got management's clear reaffirmation of 2025 guidance that provides a strong floor, right? Combine that with the aggressive $400 million buyback program, actively reducing share count, boosting EPS. Then there's that differentiated focus on high growth areas, DAS, edge data centers, potential new revenue streams.
That's the catalysts we just talked about.
Exactly. Add those clear second half catalysts, Q3 print, buyback completion, potential M&A tailwinds. You've got a scenario potentially ripe for that re-rating we discussed.
So if INWIT successfully shifts perception from bond proxy to controlled growth compounder,
then those options could see significant leverage, especially as the stock approaches or maybe surpasses its 52-week high. It's betting on that narrative shift actually happening.
High risk, high reward.
Absolutely. And just to hammer it home for our listeners, these are highly speculative ideas. Any investment carries significant risk. Always do your own thorough due diligence before making any financial decisions, please.
Well said. Okay, so to recap our deep dive then. INWIT delivered, well, a pretty solid quarter, didn't they? Reaffirming their path in a tough market.
Yeah, they did. Effectively leveraging that shared tower model for efficiency, driving impressive financial gains through things like the land buyouts, and strategically expanding into those promising areas, smart infrastructure, edge computing potential.
And their robust commitment to shareholder returns dividends, and that aggressive buyback coupled with strong operational KPIs, tenancy ratio, POP additions, it paints a clear picture, doesn't it? A company confidently executing its plan.
It really does seem that way. And just one last time, the content you heard today, informational purposes only, absolutely not financial advice.
Got it. So as you reflect on this deep dive, maybe consider this question. How quickly can Italy really close its digital infrastructure gap? And what does INWIT's specialized approach, urban density, new digital services, what does that mean for the wider European tower landscape beyond 2025?
Yeah, will this focus strategy make them the ultimate winner in the long game of 5G? It's a key question.
Definitely something to think about.
Well, thank you for joining us on the deep dive. We truly appreciate you listening and always welcome your insights. Until next time.